Hey, everybody. Welcome back to another episode of Palm Coast Real Estate with Brett. Today, we are going to be covering my extensive first time home buyer guide. Let's go ahead and get started. So, understanding the home buying journey. Buying your home is one of the most exciting milestones in life. It involves key several steps from securing financing to finding the perfect property, finalizing the deal, and knowing what to expect ahead of time makes things a heck of a lot less stressful. Major steps include getting your pre approval, searching for and finding the ideal home, making the offer, negotiating, and closing the deal and getting your keys. Now, let's prepare your finances. What's your credit score? You can check it for free by any of the three major credit bureaus. They can provide you one free report per year. A lower credit score may not necessarily stop you from getting a mortgage, but it can very well result in a subprime rate, meaning it's going to be a higher interest rate. If you have a credit score that's down in 500s, maybe even the low sixes, there might be certain lenders who don't want to lend to you, period, as well. So, steps you can take to improve your credit: avoid other applications of credit. Don't go apply for a new car loan or anything like that, new credit cards, and pay your other credit lines on time. How much should you save for a down payment? Many people spend years saving, which is totally fine. If it gets to be, 5 years or more, that could be problematic because home values do tend to increase over time. Sometimes, if you needed $50,000 for a 20% down payment a few years ago, and now home values have appreciated, maybe that 50,000 is no longer the 20% you were saving for, and now you're putting it off even longer trying to get to that 20% down payment. You don't have to get to 20% down payment. We'll talk about that on the next slide. You can get a lower one. Now, budget, I would just recommend to shop within your means. Get a household budget together, and you don't have to take the largest loan that a bank is going to offer you, because they will offer you what is in general much bigger of a loan than I would find appropriate or safe for my monthly budget. Keep in mind that the average person sells their home after around 7 years. So your first home doesn't have to be your forever home. You're probably going to have to make some compromises, maybe get a more modest starter home. There's absolutely nothing wrong with that. And trading up once you've built up some equity in that home, or maybe your income has improved. As far as debt goes, it's a great idea ahead of time before applying for your mortgage to reduce your current debt obligations, because they do consider debt to income ratio when you're applying for a mortgage. And just having less debt, less credit card debt, student loans, car payments, it's going to lower your risk of default on your mortgage payment, just because you're going to have less strain in your monthly budget. Finding a lender. So, what's a mortgage broker versus a lender? A mortgage broker is a person who shops for loans from different lenders for you. Usually, they are paid by the lender for bringing them the business. That's something you can ask your mortgage broker if you decide to go that route, or you can go straight to a lender. If you go straight to a lender, I would recommend shopping around, talk to at least two or three different ones and find a loan officer that you like and trust, and see what they're offering you as far as loan amount and interest rate. Now, pre-qualification versus pre-approval. What are the differences? Pre-qualification is a very preliminary step. Usually you're going to walk out with a pre-qualification the day you go in and apply for the loan. So that means that you're going to go in, tell them, this is my employment history, income, assets, debts, all that stuff. And they're going to look at, basically, they're just going to take your word for that day and tell you, assuming all of this is true, this is about how much we would be willing to lend you. Then after you leave, they're going to run your background check, credit history, verify your employment, assets, debts. And then usually within a few days, they're going to give you an official pre-approval letter. And that's much more concrete, and that's what you want in the end. Now, different loan types. These are going to be your most common here. You've got your conventional FHA loan, VA loan, and USDA loan is a little bit less common. And I have on here minimum down payments for the different kinds of loans. You can get as low as 3% here for conventional, 3 to 5 depending on the lender. FHA loans, you can get as low as 3.5% down, and VA, obviously you'd have to be a veteran, and USDA is more for low income rural properties, but those can be as low as 0% down. Now, as I mentioned earlier, the traditional down payment is 20%. The reason for that is that the lender doesn't want to have 100% or near 100% of the value of the property in their name because the market fluctuates. So if, say, you buy the home and they had put 100% down with no insurance or anything, and the market took a dive, and then you defaulted on your mortgage and they have to repossess the property and sell it to get their money back, now it's no longer worth what it was when they gave you the loan. So if you're putting 20% down and the lender does 80%, the market usually doesn't fluctuate more than 20%. So they are confident with only 80% value in the property that they would be able to get their money back if they needed to foreclose on you. So if you're putting less than 20% down on a conventional loan, you're going to be paying private mortgage insurance, or PMI. Usually that will go away once you reach that 20% equity threshold. That's something to double check with your lender. If you are doing a lower down payment on a conventional loan, you don't want to be stuck paying that forever. You won't have private mortgage insurance on any of these other types of loans because they're not private loans. All the rest of these are insured by the government in some way. But rest assured, you are in some way paying for that through fees. There's no getting around that extra fee if you're coming into the purchase with a small down payment. Now, as far as down payment assistance programs go, there's quite a few of them. As far as I can see, the different types are ones that come with concurrent payments, meaning you're going to have to start paying that down payment assistance back at the same time as your mortgage. I'm not a fan of those at all. That's also going to increase your debt to income ratio, which is something that your lender is going to take into account. It could end up meaning you qualify for a smaller loan in the end because you have another concurrent payment now. Deferred payment, down payment assistance, not bad, nothing wrong with those at all. You won't have to pay them back until after your primary mortgage is paid off. However, the best, in my opinion, are forgivable loans. These are types of down payment assistance programs where, as long as you stick to the parameters that they set to the program, say maybe sometimes they're living in the house for 5 to 10 years, that down payment assistance that they gave you will be forgiven over time and you never even have to pay it back. It's essentially free money for you. So who doesn't love that? Now, finding an agent. Knowing what you need before you start can help you save time and make confident decisions. So think first and foremost about where are we searching, what's our location, home size, and must-have features of the home. Find a trusted buyer's agent. Again, same with the lenders or mortgage brokers. Nothing wrong with interviewing multiple agents to find one that has a good vibe, that you trust, and make sure that you communicate well with each other. Whether it's just in person, you communicate well, or whether it's via email, phone call, or text, whichever you prefer, make sure that they're willing to communicate in whichever method you like and that your schedules align. If the agent doesn't work on weekends anymore and you work full time during the week and can only see houses on the weekend, that might not be the agent for you. And then finally, we do need to talk about the buyer-broker agreement. If you're a first-time buyer, you probably don't know what this is. It is a 3-page document in Florida that is now required for all realtors nationwide. I just mean in Florida, it's 3 pages. And it's really not that scary. It's actually helpful for people new to the home buying process because it's going to define what is your role and responsibility as a buyer navigating the process, and what duties does your agent owe to you. And it is going to cover compensation as well. So compensation is always negotiable, but for example, let's say you agreed to pay your agent 3%. You don't necessarily have to have that coming out of your pocket. You have agreed to pay them that amount, but it also says in that document that any compensation that comes to your buyer's agent from the seller reduces the amount that you owe them. So let's say you agreed 3% in your buyer broker agreement, the agent is going to write that into the offer saying that the seller should pay that 3% on your behalf. So the seller would pay your buyer's agent. Now, it doesn't always go perfectly. Sometimes there's some back and forth with it. Maybe your agent is going to be willing to compromise a little bit on their commission to come to an agreement and keep the deal moving forward. Maybe if the seller won't pay it all, you would end up paying a portion. Or if the seller's playing hardball and won't pay it all and you don't want to pay it at close either, you could then find a different house where the seller is willing to pay it all. Now let's talk about HOAs. Not going to drain HOAs, but there's a lot of them in Florida, so they're worth at least considering. They do restrict what you can do with your property, obviously, and that's a big consideration if you're animal people. A lot of them have pet restrictions as far as size, breed, number of them. HOAs are also beyond your control generally. I mean, homeowners in the community can vote to make certain changes, but you don't know how other people are going to vote. And the HOA fees do tend to increase over time. It's just a matter of fact, just like inflation. However, HOAs do provide many desirable community amenities like fitness centers, clubhouses, pools, places to play sports, things like that, playgrounds. So it's really a personal decision if you want to live in that sort of a community and you're willing to live with the restrictions and pay the fees. Now, make the offer. You found the perfect home. Talk to your agent about how to submit a winning offer, because the agent is going to know what kind of market we're currently in, whether it's a buyer's market or a seller's market. In a seller's market, you may need to make an offer that's above asking price if you're competing with other offers. If it's a buyer's market, then they might be able to help you talk the seller down because the buyer would have the power in that kind of market. Your agent will run a comparative market analysis or a CMA looking at other comparable homes that have sold recently in that neighborhood, and they can give you a much better idea of what is going to be an appropriate price to offer for that property. You're always going to accompany your offer with your pre-approval letter, or if you're fortunate enough to be doing a cash offer, you would have to provide proof of funds. And just expect that there's usually going to be a counter offer or two before there's an agreement, because every time in any transaction, the buyer and seller both want to feel like they're getting something out of it, that they're both getting a deal. So it's much more common to have some back and forth before there's a full acceptance. Then, once you're under contract, you got to schedule the inspection. Always get an inspection. In Florida, the main one is going to be your 4-point inspection, covering your 4 main portions of the home of roof, your HVAC, your plumbing, and your electrical. Additional inspections you may want to consider if you're buying a pool home. Good idea to get that inspected. It's a big feature of the home and expensive. Wind mitigation inspections can be right for you. If it's a home with older windows and doors, it's probably not going to matter because it's not going to really pass the wind mitigation inspection. If it has newer windows and doors and it might actually pass one, then that would mean that your home is much more hurricane ready. You have good windows and doors that could stand up to high winds. So if it passes a wind mitigation inspection, you could get a decent discount on your homeowner's insurance. Wood destroying organism or WDO inspection, always recommend that. Termites, we're in a warm climate down here. They are a factor. They are active in Florida. I would always recommend that. Fireplaces, of course, being in Florida isn't as common, but if you are buying a home with a wood burning or gas fireplace, could be a good idea to get that inspected as well. And then mold inspection, because the 4-point general inspection is a visual inspection. They're not really going to be doing a deep dive into things like duct work looking for mold. So that might be something to consider as well. And it is very common to have renegotiations with the seller after you get your inspection or inspections done, because it's going to, every inspection finds something first and foremost. And then you go back to the seller during your inspection period and say, well, hey, I didn't know about all these issues when we made that offer. And you can ask them to fix some things or lower the price or give you some money at closing, basically, so you can fix some of these issues. Also, once you go under contract, you need to start shopping around for homeowners insurance. Your lender will always require it. And if you're in a high risk flood zone, they will also require flood insurance. Now, if you're moving here from out of state, some Florida insurance considerations you may not be familiar with. Some insurers will not insure homes older than 2002. That's because the state of Florida updated the building codes in 2002. So some insurers just don't want to deal with what they perceive to be higher risk older homes before the codes were updated. You can still definitely get those homes insured. My home's older than 2002, but you might just have to shop around a little bit more. Now, concrete block homes are generally cheaper to insure than wood frame. The age of your roof and water heater can be important factors. Some insurers will not want to insure homes where the water heater and or roof are older than 15, 20 years old. That's for if you have an asphalt shingle roof. If you have metal or tile, those are designed to last much longer than that 15, 20-year time frame. So you can generally insure those pretty safely for a lot longer. But just always be sure that you know the age of these major systems like roof and water heater before you purchase a home. You don't want it to become uninsurable at the time you're purchasing it or shortly after. Now, new construction overall can be much cheaper to insure. That's just because insurers don't anticipate a lot of problems with it. It's brand new. It's generally still under warranty to some degree. Most new builders give like a 10-year structural warranty. So you can save a lot of money if you do go with a new build, and it'll be cheaper for about the first decade. Even though, as I said up here, concrete block is generally cheaper than wood frame, a lot of the new construction in the Palm Coast area right now is going up as wood frame. If you choose to go that route, it can still be very cheap to insure if you go with one of these large nationwide builders. Some of them offer in-house insurance on their own product, and even if it's wood frame, I've seen some of that be very, very affordable. Now, for flood zones, X is low risk, X500 moderate. Anything that starts with an A is going to be high risk just based on the elevation. And V you don't see as often. That's really if you're right on the coast, where if a hurricane's rolling in, you have actual storm surge risk on the property. I always recommend flood insurance in Florida anyway. It's still Florida, even if you're in flood zone X, but it's not going to be required if you're in the low risk zone. And if you do decide to get it anyway, it's going to be much cheaper because you're low risk. Now, the appraisal. The appraisal ensures that the property is worth what you're paying. It's usually required by your lender unless you come into the purchase with a large down payment. Then they're sometimes not concerned and they'll waive it. Your FHA and VA appraisals are going to be more strict. They're going to look for certain safety standards like making sure there's handrails at stairs, there's no peeling paint, and there's no obvious roof leaks or plumbing or electrical issues. Now, if the property doesn't appraise, you do have some options. Your agent can go to the appraiser and challenge the appraisal. They can use that CMA they created earlier to justify the value of the property. If that doesn't work, the lender is not going to lend the full amount that you agreed to purchase that property at because the appraiser has said it's not worth it. So your options are, if you have enough cash on hand, you as the buyer could pay the difference. You can go to the seller and say, hey, this deal is going to fall apart if you don't renegotiate and lower the price to the appraised value. And if none of that works, then you may end up having to find another home. Property survey. This is usually required by your lender and highly encouraged, at least by the title company. It's just going to confirm the property boundary, and it can reveal encroachments. Say a neighbor had installed a fence around their backyard. Turns out it's actually over the property line into what is going to be your property if you go through with the purchase. So there's usually not a whole lot of problems with residential real estate with surveys because most of them get bought and sold regularly enough. But it's still good to get done. Like I said, it's usually required anyway, but you're not just purchasing the home, you're also purchasing the land that it sits on. So you want to know where your property boundaries are. Now, title commitment and insurance. After you go under contract, The title company is going to begin to run a title search, which will look at things like the history of ownership of the property, and they're going to check and see if there's any liens on the property, things like that. After they run the search, they'll issue a title commitment, which sometimes can come with stipulations like if they found a lien on the property, it'll need to be paid before close or at close to make sure that lien is resolved before you as the buyer take possession of the property. Now, there's two different types of title insurance. In Florida, the seller usually pays the owner's title policy, which actually insures you as the buyer, saying that if something was missed in the title search and after you take possession of the property, ownership of the property, a title issue comes up, their owner's policy will cover you as the buyer. And then you as the buyer also pay a policy that covers your lender in the event that a title problem would surface. So always get title insurance. It's not that much money, and it's generally a one-time fee you pay at closing. It's just not worth the risk to not have title insurance. Now, we're almost there. We're going through our closing checklist now. Once you've gone under contract, gotten the inspection done, renegotiated, you found your home insurance, you got your survey done, your property appraised, all that stuff, your lender, once they're done with the underwriting and everything looks good, they will issue you what's called a clear to close, meaning you are pretty much good to go. You're right there. They'll also give you a closing disclosure, which needs to be given to the buyer at least 3 days before close so they have time to review it. And that will have all the final numbers of, what you're paying, how much you're borrowing, and how much you need to bring to close. And there shouldn't be any surprises in these final numbers in the closing disclosure. You should have all that information well before then. This is just the final version. If there's a bunch of changes in it, then that's a red flag. Now, your final walkthrough. Final walkthrough, you always have a right to do one as the buyer, and generally it's the morning of close or the day before. And you're just going there to make sure that the property is in the same condition that it was when you went under contract, that the seller got all their personal possessions out of the property or left some if you agreed to purchase some maybe through a separate bill of sale, and that they made any required repairs after your inspection renegotiations. Finally, at close, you're going to review and sign your documents, transfer the funds to purchase, you're going to get your keys, and then congratulations, you navigated the buying process successfully and became a homeowner. So I hope this was helpful for all you first-time home buyers out there. If you thought so, please like the video, subscribe to my channel, and if you need a good agent in the Palm Coast area, don't hesitate to reach out. The socials are all on my channel. Reach out to me if you need me. All right, thanks guys. Thanks for watching.